New York City on this Monday, November 11th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know this morning.
Good morning, everyone. First up, the stock rally continues. Equities kicking the week off in the green here after hitting record highs following the re-election of Donald Trump. The S&P 500 hitting its 50th record of the year in Friday's trading session. Now, investors await the latest read on the economy. We've got October inflation data out Wednesday, plus retail sales numbers on Friday.
Plus, stocks aren't the only trade hitting record highs. Bitcoin rallying past 82,000 for the first time as investors remain optimistic about the digital currency under a Trump administration. Bullish sentiment also lifting smaller coins, including Dogecoin and the meme crowd favorite promoted by Elon Musk.
And earnings season, it continues. Results from Home Depot and Disney, the House of Mouse, later on this week, providing a look into the state of households and spending that's taking place. Investors will be watching Disney's streaming subscribers closely as growth in that business offsets a slowdown in theme park demand. Meanwhile, for Home Depot, higher mortgage rates may be weighing on the renovation activity, but the company could benefit from repairs needed following hurricanes in the U.S. South. The company may also shed some light on how retailers plan to deal with tariffs under a Trump administration. Well, U.S. stock futures kicking the week off in the green here as we're about 30 minutes outside of the beginning of the trading session here. We're taking a look at the major averages on your screen, fractionally higher across the board. We've got a huge week ahead. Earnings, CPI, retail sales, and our second annual Yahoo Finance Invest Conference here in New York City. Of course, under the name Invest, but of course it has been going on annually for years now with much fanfare, great conversations. You know, even as we're kind of leading up to that and the tenor of the discussions that are really going to be taking place around a couple big themes and all with the backdrop of this market hitting new all-time highs where we were talking about the S&P 500 and the 50th record high that we've seen over the course of 2024. Larger question of, for some of these companies that are going to be in representation there, and you've got a huge interview with one of the companies that would argue that AI has been a theme for them for decades. I'm talking about IBM. And of course, as we're thinking about what type of legs that theme has left in it, that's going to be a central driving force, I think, around a lot of the thesis and discussion.
Yeah, Brad, I think you're exactly right. And I'm looking forward to my conversation with Arvind Krishna, the CEO of IBM, talking about just that and really just where things stand right now. I think as we take a step back, taking into account what you were just talking about, so much of that excitement surrounding AI and investment opportunities, that certainly has been the story here for the markets going past over the last 12 to 24 months. But I think now, especially with President-elect Trump returning to the White House, lots of questions just about the road ahead for big tech more broadly, what exactly the antitrust landscape is going to look like, and ultimately what that means for the AI play. There have been a number of strategists coming out saying that this is actually the best outcome possible here for the AI industry going forward, just given the fact that later regulation could prompt some more M&A activity and exactly what that looks like then in terms of the advantage that we could see for some of these larger tech companies. So I, of course, will be looking forward to that interview. But that's far from the only conversation that we will be having. I also will have the opportunity to speak with Chris Licht, the former chairman and CEO of CNN, talking about the media landscape right now, especially with Trump returning to the White House. That, of course, will be great to get his insight on. And of course, just where the media landscape heads from here. We talked about consolidation, obviously media very much playing a critical role in that and what that could look like here over the next 4 years. And it'd be great just to get his insight, the first big interview he's doing since he did leave CNN. So of course we have a lot to catch up on, but it spans across multiple sectors. You talk about Bank of America CEO, who will also be there, Brian Moynihan. So it's across politics, it's across businesses. It's the biggest leaders that you want to hear from, trying to figure out what exactly makes sense for the best investment strategy going forward. So I'm very, very much looking forward to all of the conversations tomorrow.
And if you're not in the room, you can scan that QR code on the screen. Of course, you'll be able to watch it live. I can't wait to MC tomorrow. Just kind of hopping between.
You got a big day ahead of you.
We do. Tall task. And I'm going to have plenty of, as Brian Sazi has on his desk, plenty of Celsius drinks, I suppose, or whatever energy drink
he's really hitting these days.
You know, that aside, there's a lot of huge earnings reports, if you're a consumer out there, your ears are going to be burning because you're going to feel like you're being talked about, and it's because you are this week. You've got names like Home Depot. You've got names like Alibaba for those who are waiting for Singles Day. Wait, it's today. Oh my gosh, 11/11. Look at that. And then also you've got Disney, Walt Disney Company, and some of the top 4 or 5 companies that are reporting earnings this week account for about $1 trillion in market cap combined. So all of that, consider Shopify as well, another consumer name. We got a lot of consumer names, and we're also got some a little bit of Fed speak later on in the back half of the week too.
We certainly have a busy week here, not only at Yahoo Finance, but obviously around the investment world. So let's turn back to the market rally that we have been tracking ever so closely. The S&P 500 hitting its 50th record of the year as investor sentiment remains positive following the presidential election. Joining us now, we want to bring in Alexander Morris, FM Investments CEO and Chief Investment Officer. It's great to have you back here, Alexander. Let's talk about the sentiment right now within the market. It almost seems like nothing is going to stop this move to the upside that we have been seeing more broadly. What's your take just on where things stand today?
Well, I think you're right. Nothing's going to stop this move to the upside. It's a little bit of a surprise, right? Going into this, the Trump trade was seen as short equities and bear steepener. What we got was bear steepener plus long equities. And if you were short equities in any way going into this, you were really disappointed, and you're probably going to be. And as we go to the fundamentals you're just talking about, things are probably just going to get a little cheerier for companies over the balance of the year. So it seems like being long mega cap stocks stayed to be a good idea. Being long stocks in general is a good idea. And it's probably a good play through the end of the year.
You know, Alexander, taking you into some of my conversations with friends over the weekend, many of them saying, hey, 50 all-time highs for the S&P 500. There's a lot I've been cheering about, but should I be cautious right now, especially where the exuberance has seemed to play out in such a manner that investors are trying to figure out, okay, what, if any, is the next shoe to drop at this point? Because now it's going to seemingly, or at least history would suggest, at some point it's going to turn into a show me story that deregulation would have to lead to more of the potential acquisitions or deal making environment, or that you would, in the crypto landscape, that you would need to see more purchasing from government entities. So all of these things have to have some type of element to show up to say, all right, this is actually happening, and what has been touted as the Trump trade is going to play out because of either policy or some other matter as well.
Markets always are looking for that thing to say, here's why it's not going to work, right? And a lot of newsletters and a lot of research gets published around that. But long term, it turns out just being long and relatively perma bullish tends to be the right idea. Market timing rarely, if ever, works. Getting it right once is luck, twice is, just really, you just happen to really get lucky. It's hard to really time that. And I wouldn't try. I think investors are smart just to kind of play the trend here for a while. It's going to continue to work, it seems. When it doesn't, you'll have the opportunity to back off and reposition. But it's why we encourage investors generally to have an asset allocation, have a plan, and stick to it. So when you get things that you think are maybe getting a little too frothy or a little too nervous, you don't have to make that big of a change to your portfolio. For the short term, though, it does seem like there's a lot of enthusiasm for equities. There's a lot of cash coming back in. There's been a historic amount of money sitting on the sidelines in money market funds. Not all of that's going to come piling back in, but you don't need a whole lot of it coming in to just keep this rally pushing through for the next few months.
Alexander, is the case of FOMO setting in once again, do you think, for investors?
I would think so. I think a lot of folks felt like they missed out on a handful of what folks might now say are easy trades, but this one's a pretty simple one. Just stay put. Most folks were relatively well positioned to be long equities. They should stay there. For your other cash, the short end of the curve, still nice, reasonably great return still with a 4 handle on them. Those were unheard of a decade ago. So you've got a pretty simple barbell approach here that I think investors are pretty well positioned for. If you want to start to really take advantage, though, you can start to extend your duration. You can get into some, shorter term, midterm investment grade credit if you want more yield. But otherwise, any of those are good choices, and it seems like it's a pretty good place to be.
Alexander, how firm or how muted is the impact from the Fed right now as they've continued to communicate what their cutting cycle may look like, and we're waiting for more clarity around what a terminal or a neutral rate could also kind of tend to portend for the markets as well. But you have a spat or a brouhaha perhaps that's brewing right now between President-elect Trump and Fed Chair Jay Powell, who he actually put in that position. So clashing of minds in some sort of capacity at least, but the Fed going to try and maintain its own kind of apolitical stance, of course. What do you think that kind of plays out for the markets here?
Jay Powell made it very clear. The Fed is going to maintain its stance exactly as it is today with no real change. And I mean, he said it in as few words as I think he could. No, and not permitted under law. It doesn't get any clearer than that. He's not going to be swayed by what I think whatever executive policies might come into play. But the Fed's also been very clear. Believe us, believe our narrative. And they've been on a relatively straightforward path for cutting. They intend to stay there, it seems. And I don't think they really need to do much or even worry about policy matters for at least 6 or 8 months. It's going to take a while for a new administration to come into place, for those policies to actually start to have an impact, and then for it to trickle its way through the economy. The Fed also has been very clear about its positioning. It's data dependent. It wants to react to what the economy is, not try to guess what it will or should be and make preemptive changes, which is why that 50 basis point cut might have been surprising to some, but it shouldn't be surprising if the Fed just sticks on its policy exactly as it's forecasted now.
Alexander Morris, who's the FM Investment CEO and CIO. Thanks so much for taking the time here with us this morning.
Thank you.
Certainly. Well, investors are going to be watching for the latest read on inflation this week with October's CPI report out this Wednesday, followed by retail sales data at the end of the week. Joining us now for more, we've got Gus Faucher, who is the PNC chief economist. Gus, great to have you here. You know, as we think about what this holds for the Fed and their own decision making coming after the data prints, of course, this week, what do you think this sets up for their next meeting, their final meeting for 2024?
I think we see another 25 basis point cut when the Fed meets on December 18th. Inflation, although it's making slow progress, it does continue to cool. I think that we are seeing in particular slower growth in housing costs that is going to result in lower inflation. And so I think they feel that with the labor market about where they want it, with inflation slowing, that they feel comfortable cutting by another 1/4 percentage point on December 18th. But I think they are going to be cognizant of the fact that they need to pay attention to inflation. And if they're not making as much progress as they like, then in 2025, it could be they cut every other meeting, something like that.
Gus, is inflation the key metric to watch now instead of jobs?
Well, I think if the labor market stays where it is, then I think that's fine, and I think they can afford to focus on inflation. If we start to see a deterioration in the labor market, the October jobs report was very difficult to read because of the Boeing strike and the hurricanes. But if we start to see a deterioration in the labor market, then I think they cut more aggressively. I think Chair Powell has made that clear. But as of now, they want to see further progress on inflation. I think they will see further progress on inflation. And that allows for gradual 25 basis point cuts on December 18th and then probably through the first half of 2025.
Do you think that wages will continue to be supportive of their path in fighting inflation right now?
I do. We continue to see wage growth gradually soften. At the same time, we have strong productivity growth, output per worker, and that allows for a little bit stronger wage growth that without leading to inflationary pressures. So I think that wages are moving in the right direction. They're still rising faster than inflation, so real wage income is going up. And I think that that's what the Fed wants to see. And I think with the unemployment rate, somewhere a little bit north of 4%, I think we'll continue to see a slight cooling in inflationary wage pressures coming from the labor market.
Gus, I'm curious just to get your assessment of the economy, because lots of talk just about soft landing, no landing, what exactly that looks like, especially now with the change coming in the White House, and lots of talk just about the Fed's role and how influential maybe the next president is going to be in that. How are you assessing that as an economist?
I think the economy is in very good shape, and I think President-elect Trump is stepping into a very good situation. The labor market is at full employment right now. The unemployment rate is just around 4%. We're continuing to add jobs at a good pace. Wages are going up more quickly than inflation, and we are seeing inflation slow. It has been very elevated over the past few years, but we are seeing inflation slow, and I would expect that we will continue to see inflation slow in the near term. And I think that we will see inflation hit that 2% objective sometime in the spring or early summer of 2025.
As we think out to next year and, of course, the changing of the guards within the White House, and we're still waiting to see what the full balance of power will look like in Washington, D.C., are you concerned about any type of spike in inflation again if we do see some of the campaign promises come true, and especially around many economists' projections on tariffs?
Yeah, certainly I think that tariffs would lead to higher prices for consumers and at least temporarily higher inflation. I think the question for the Fed is, do these tariffs mean that the level of inflation has gone up, i.e., that is, it's above 2% consistently, or is it just a one-time jump where we see prices go up somewhat and then they settle back down to 2%? So that's what's going to matter for monetary policy, what the Federal Reserve thinks about it. But I don't think there's any question but that tariffs will be inflationary, at least in the near term, and the Fed will need to decide how to respond to that.
Gus Fauché, who is the PNC chief economist. Thank you.
Thank you.
Coming up next on Morning Brief, we'll have more on the Bitcoin rally and stocks moving amid its surge. You're looking at Bitcoin just below 82,000 right now. Plus, we hone in on earnings and get a preview of what to expect from Disney. And count you down to the opening bell on Wall Street as U.S. stocks trade in the green. We'll discuss that and much more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk a little crypto. Crypto stocks rallying as Bitcoin climbs above $81,000. Cryptocurrency is extending last week's rally following former President Trump's re-election and election win as investors bet on pro-crypto policies here. There you're taking a look at Coinbase, Marathon Holdings, and then Rocket Lab. I don't know if we have MicroStrategy that we can also toss up here, as they have this morning announced that their Bitcoin activity, they have raised $2.03 billion and purchased 27,200 Bitcoin, now holding a total of 279,420 Bitcoin, which is more than the entire United States government holds as well. We should note a yield of about 26.4% for MicroStrategy year to date. Shares jumping on that release, up by about 10.8%. And since I mentioned the government entities, I mean, what we'd heard along the campaign trail and from some of the public appearances that President-elect Trump had made as part of his campaigning was about the strategic Bitcoin reserve that he would like to set up. Now, the United States already owns 208,000 Bitcoin, over 208,000 Bitcoin, and is the leading government entity holding as of right now, which has actually jumped over the course of 2024 here. China coming in next at about 190,000 Bitcoin, and both of those entities, I mean, are far and away the largest leaders, two largest countries by GDP and two largest economies by GDP holding the most Bitcoin right now, and the potential that there could be even more purchasing activity from economies certainly kind of adding to some of the fervor for the Bitcoin price action that we've been seeing.
Yeah, I mean, it certainly has been nothing short of remarkable just looking at the massive rally that we've seen in crypto. Not so much a huge surprise just given the outcome and not only having Trump returning to the White House, but also seeing what has played out on the Senate races and also what could potentially play out in the House, which of course could be critical just in terms of the passage of regulation and what exactly that looks like here over the next 4 years. And just to illustrate how excited investors are about President-elect Trump returning to the White House, crypto investors, I should say, at least just in terms of the opportunity that they see from this trade. Bitcoin ETFs posting a record daily net inflow of almost $1.4 billion on Thursday. On Wednesday, the iShares ETF trading volume jumped to an all-time peak. All signs of how Trump's victory is really starting to reshape, or viewed here, that he could reshape the crypto market. Not to mention Gary Gensler also likely out as the SEC chair. What exactly that means just in terms of the direction here from a regulatory perspective and how that all plays out going forward. But again, we have certainly seen this march higher, a steady march higher that's really been catapulted here from the results of the election. So here we are today, right around 82,000. Getting closer and closer to that $100,000 level.
Yeah, I imagine every seat that Gary Gensler sits on feels pretty hot or heated at this point.
Yeah, you would think so.
Yeah.
Feeling the pressure. All right, let's take a look at Taiwan Semiconductor, ordered by the U.S. to halt shipments of advanced chips to Chinese customers starting today. That's according to a report from Reuters. Now, the Department of Commerce sent a letter to the company imposing export restrictions on certain chips used to power AI accelerator and graphics processing units. You're looking at a decline of about 1.4%. And with that decline, you might be asking yourself why we aren't seeing a bigger drop in this stock here today. No doubt from Citi, a quick reaction really got my attention because I think it did a good job of explaining as to why we aren't seeing a bigger drop. And the reason that they put forward is that they actually see a minimal impact from the reported suspension here of AI chip sales. Why? Because China's clients make up about just 11% of revenue and deal with mostly non-AI applications. So they went on to say that they expect TSMC's growth outlook to remain intact. The potential further tightening of HPC shipments to China. These orders may go to regulated chips such as Nvidia's H20, but they will still benefit TSMC. So again, I thought they did a good job of explaining the minimal impact there and why we aren't seeing a bigger drag on that stock this morning.
Yeah, this is one area that we could see ramp up even further going into next year. You think about some of the tit-for-tat spat that really played out back in from 2017 through 2020, and Huawei being perhaps a household known name, but for worse, because of the fact that it was really at the center of some of that. And once again, it's at the center of these discussions too, with the U.S. and the Commerce Department here, because TSMC had actually provided and given the notification to the Commerce Department where its chips were actually being located in an AI processor by Huawei. And so with that in mind, Huawei is still very much within the throes of how this is playing out, especially as the Biden administration has really only added on its own factors that it's considering, especially as it's spending and earmarked its own and earmarked the U.S.'s own money towards chip production through the CHIPS Act and making sure that more of that is being homegrown. And so with that in mind, Huawei, TSMC, still very much in the throes of, and despite the fact that TSM has some of its own factories within Arizona, all of this considered, Huawei might be one of the continual political, unfortunate punching bags as a result of all this, now that you layer on the AI component of the chip landscape right now. Also here, let's finally talk a little Tesla. Betting against Tesla is costing hedge funds. According to Bloomberg, hedge funds that had short positions in Tesla between Election Day and Friday's close lost more than $5 billion. Taking a look at shares of Tesla, they're continuing to move higher here pre-market, up by about 7.6% right now. Of course, Elon Musk had really been almost locked arms with former President Trump and now President-elect Trump during the campaign cycle and even during some of the most contentious days, final days of the campaigning leading up to Election Day. And now Elon has been able to cash in on that, as well as many of the Tesla shareholders out there. His net worth has grown, ballooned by a couple dozen $1 billion. And for everybody else out there, they've made a little bit more than they had in their account before.
Yeah, they made a lot. Tesla shares up about 30% since the November 5th election. It represents about $200 billion in market cap value. If you take a look at market cap value here ahead of the open for Tesla, just above $1 trillion, something that we have been closely tracking here over the last several trading days. We heard from Wedbush's Dan Ives that he was expecting Tesla to very quickly soon cross that threshold, and ultimately what that means there maybe for demand going forward. I also want to point out that many hedge funds, though, did move to quickly reverse course following Musk's endorsement of Trump, going back to what we saw this summer. So yes, many shorts did lose a heck of a lot of money on this bet, but it's only a fraction of what that could have been. As of November 6th, only 7% of hedge funds were net short of Tesla. That was down from 17% in early July. So many have moved over the past 2.5, 3 months here in order to get ahead of this trade. Those who didn't, obviously, are forced to cough up a lot of money, potentially. And
it could have been worse.
A lot of money.
Could have been way worse.
Could have been a lot worse. All right, keep it right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Morning Brew.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Just about 10 seconds here until the opening bell on Wall Street as investors brace for what is going to be another busy week here for the markets. A couple of key earnings prints on deck here give us a better sense of the health of corporate America right now, and also looking ahead to some of the key econ data prints that we will be getting out later on this week. Key readings on inflation. We also have a key reading on retail sales that will give us a better look at the consumer. You're looking at the opening bell right now on Wall Street. Let's take a look at where things stand here for the broader markets. If I could get the touch here, the Dow up just around 0.5% here at the open. Again, a push further here to the upside, coming off a record-setting week here for the markets. As we flip over, we're looking at gains here across the board as the touch catches up here. You've got the S&P now up just about 0.3% above 6,000. Again, lots of questions about what that momentum is going to look like here as we break above that 6,000 threshold. There have been a number of calls out this morning, including John Solfis over from Oppenheimer, talking about the fact that there is still some of this momentum here to the upside. Small cap trade will also be important to keep in mind, given the magnitude of the jump that we've seen from the Russell 2000 since Trump was elected. You're looking at further gains here this morning, up just about 0.7%. Let's take a look at the heat map here inside some of the sector action that we're seeing here at the open. You've got consumer discretionary, financials, it looks like here leading the way, but it is a bit of a mixed picture. You've got healthcare, energy among the laggards here in today's session. Also consumer staples not too far behind. To take a look inside the Dow, some of those larger cap names here, seeing where they are trading. A bit of a delay here, but you've got Apple under some pressure here this morning. But again, Nvidia, Microsoft, Amazon, some of those larger cap tech names pointing to the upside. Nvidia, you can notice now in the Dow up about 0.3%. Jared Blickery standing by for a closer look at this. Jared.
Well, thank you, Shauna. We have seen an explosion of volume here and just interest in stocks. Let me just go back to the Russell 2000. By the way, the Dow and the S&P 500 coming off the best week in a year, but I did want to focus on the Russell here because, and I'm going to put on a longer term chart, a 5-year chart, so you can see we are right back within 2% of the record highs, and it has been a long and steady slog, but you can see this base here, and we have not broken out yet, so we don't want to celebrate too early, but that is a solid base, something to look for. We've just seen a lot of markets in their own way, in their own time, with their own chart patterns breaking out over the last 2 years, and small caps have been the real laggards here, and we'll get to some others in a second. Here's the 10-year T-note yield. That's a 5-year chart. Let me take this down to a 3-month, and we can see it has not been causing trouble lately. It is off of these highs there. These highs, 4.4%, could be a problem, but we are nicely below them, so not looking at any interference today. But the U.S. dollar index is heading higher, and that's something we want to keep our eyes on, and that's fine if the U.S. is growing, if this is about a growth story, but what you don't want it to be is a panic story, and we're not seeing anything like that right now. You can see, however, we are at the highest levels in about 4 months. And let me take a look at the sector action again. As Shauna pointed out, it's really the cyclicals that are leading, and that's not a big surprise. Consumer discretionary, that's XLY, that's up 1.65%. Financials, industrials, all outperforming. The cyclicals have this story of pent-up investment, that there was an expectation that there would be a wave of CapEx being unleashed. That's capital expenditures, investment for the future, and we might be seeing the beginning of that right now. Taking a look at our leaders, it's been all about Bitcoin. Well, not all about Bitcoin, but Bitcoin has been a major story over the last week, and GBTC, that's my ATF proxy, up about 7%. ARK Innovation Fund, that is up 3.5%. Regional banks, 1.89%. Then you got the small cap. So really nice mix of cyclical markets here. One story that is kind of cyclical and not in the normal way is chip stocks. SOX is down 1.34%. So not everything participating today. But I did want to get to the futures, and then we'll get to Bitcoin. In futures land, we are seeing not only gold, but silver drop to 1-month lows. And I'll show you what's happening in gold. That's the intraday overnight price action. Here's the year to date, still looking at gains of 27%, but just a little bit off of those highs there. Finally, Bitcoin, let's take a look at that. Holding above 80,000, real nice move here. Let's get a 3-year chart so we can see, and let's actually get a 5-year chart so we can see the lead up to this latest breakout. And it has been quite the story, and just the way we are waiting for the Russell 2000 to kind of flag, and maybe provide a breakout. This is that similar pattern that happened in Bitcoin, and now we're just waiting for the breakout, guys.
All right, Jared Blickery, thank you so much. Appreciate it. It's time now for today's strategy session. With stocks hitting new highs following the election, what investment considerations need to be made going into a new administration? Joining us now is Jamie Batmer, who is the Creative Planning Chief Investment Officer here. Jamie, good to have you here with us this morning just after the opening bell. As you're thinking out to some of the themes that you think will be most prominent for investors in 2025 and after, of course, the changing of the guards in D.C., what most notably are you kind of aligning your portfolio strategy around?
Well, first, thanks, Brad, for thinking of us. Thanks for thinking of creative planning. Good morning. The real key consideration is not to let all the excitement, all the rhetoric, all the noise coming out of the election truly dictate investment decision-making. Because everything we do is driven by the historical empirical data and academic research. And all of it says is that the rhetoric is oftentimes the exact opposite of what occurs. We all talk about, the markets aren't red, they're not blue, they're green. But underneath the hood, people still say, this sector's gonna benefit, the fact that there's a renewed Trump administration, or this sector's gonna underperform because Harris lost. Well, historically speaking, the data just doesn't support that. You pull 100 people on the street, they say, is a Democratic or Republican administration going to be better for renewable energy? 100 out of 100 people say Democratic. Well, under Obama, and then Biden, it was down about 50%, and Trump, renewable energy was up about 300%. But I'm not here to say, okay, look at Trump winning. The exact opposite can be held true of other sectors. Take big banks. You pull 100 people on the street, say, who's better, Democrats, Republicans? They'll all say Republicans. Well, big banks did nothing under Trump's first 4 years, and on average between Obama and Biden's time, they were up about 75%. So don't let the noise, the rhetoric drive things. Focus on what you can control. Some of those key end-of-year things and in broader diversification and asset allocation decisions.
Yeah, well, Jimmy, talk to us a little bit more then about what you are telling investors to do right now between now and year end.
Yeah, again, those things you can control. You can't control what sectors are going to take off. You can't control who won the election, but you can absolutely control what you need to do. Rebalance. But you got to keep doing that. People think it's like a December exercise. No, that means all the volatility you think might only happen in December of the year. I mean, we only have to remember March of 2020 to realize how that's not true. Sorry for bringing that up again. But the idea, okay, what can you control? Obviously, the tax loss harvesting, making sure you're funding charitable accounts, funding those accounts that give you optimal returns. Like take a 401k or 403b if you have one, or your kids have one, or your grandkids have one. If you're not maxing it up to the match, you're essentially giving up a free 100% return and this beautiful tax benefit that comes with it. So if you're not maxing out before year end, and maybe you have some money on the sidelines, or you can help a family member out with giving them some money so they can readjust what they're contributing, that's what you have to focus on, because that just guarantees a more effective outcome instead of trying to crystal ball foretell the markets.
Jamie, of this earnings season, what's jumped out to you as one of the key themes that you've heard from companies that is really going to impact, at least more broadly, the thesis or the trade that's been prevalent to this point, which is around AI and where the shoes are going to start to drop for those companies that just blindly would say it on a call, but didn't really have anything to do with their business? Yeah,
I mean, there's always a hot dot to chase. I mean, sure, are we maybe in a tech boom or bubble now? Maybe. It wasn't that long ago we were in another tech boom that went bust, and the markets are just fine since then. They've been up hundreds of percent, but Cisco, the darling of that moment, is still down about 70%. So as long as you're not over-concentrated, you're unemotional, you'll be fine. Really what stands out to us is the continued reiteration of just how strong the underlying consumer is. Consumer driving 70% plus of the overall economy, and just how resilient they've been. And really, interest rates going up hadn't had the impact that maybe the Federal Reserve thought it would have, or what it had done traditionally. I think a lot of that is driven by just the changing dynamics of the underlying consumer. Baby boomers, this huge bump in the python as they get older and older, they're not impacted as much. More than 50% of them don't have any mortgage attached to their house. So they don't care that mortgage rates are going up. They actually like it because their money in their bank, the interest on their bonds are paying more. And so you're seeing that in restaurants being packed, airports being packed, cruise lines being packed. So really, actually, yes, AI is the hot don of the moment, but the underlying strength of you and I spending money as American consumers is the key, and that continues to be reiterated as surprisingly strong.
All right, Jamie Battner, we have to leave it there. Thanks so much.
Hey, thanks a lot. Have a great week.
Thanks, you too. Let's kick it over to Madison Mills, standing by for a closer look at today's chart of the day, an international spin. Maddie.
That's exactly right. We're going to take a look at China here. If I can pull up that chart right behind me here. China nearing a record $1 trillion trade surplus, hitting its third high of all time here in terms of surpluses in trade. So what does that mean? That surplus is going to be the difference between exports and imports. So this is telling us that the majority of China's economy is really relying on those exports. And the imports, not so much. That is indicative of the fact that the Chinese economy is still struggling to recover following the pandemic. And that is when we started to see this challenge for the Chinese economy really starting to tick up here. Now, this presents an interesting dynamic heading into a Trump administration, right? Because we know that Trump has teased out the idea of tariffs on Chinese exports moving forward. Now he's got the upper hand with China's economy really relying on those exports as a major part of their growth story moving forward. That gives the Trump administration, again, the upper hand heading into any of those tariff negotiations here. So not only could this dynamic have the potential to cause a trade war, it could also potentially lead to some currency issues. We've heard India speaking up about being comfortable with the rupee weakening if China does allow for the yuan to continue heading in this direction. So that is also something to keep in watch here, both the potential impact of a trade war and a potential currency war, guys.
All right, Maddie, thanks so much. Really appreciate it here. We're just about 11 minutes into today's market action. We've got much more on today's trading session, plus what's ahead this week. Stay tuned. You're watching The Morning Brief. Disney is set to report its latest results after the close Thursday this week. So, what are the keys to the House of Mouse that investors need to watch in this report? Even as you're taking a look at shares here, up today by about 1.25%, here are the three key things that I'm keeping close tabs on. Number one, some of the expectations for the streaming subscribers. We've seen, of course, across the board from many of the players within this direct-to-consumer entertainment landscape, more focus on what the pricing needs to be in order to really keep pace with the North Star that is Netflix in the streaming business. This has incited activist campaigns, and for Disney, it's placed even more focus on where they need to extract value from consumers. That's also meant even more focus on where there's churn and where you're actually seeing consumers flock into some of these services. Here's what's expected: 1.512 million net adds for the overall streaming business. And there's a larger question going forward from here as to what we could see in terms of more consolidation coming in 2025 across the streaming landscape, but more so what bundling we may see take place. And we discussed this with Geeta Ranganathan of Bloomberg Intelligence last week, who said to us, we've already seen Disney and Max kind of come out with one bundle. They're both already out there, and then Warner Brothers Discovery, they had reported last week as well, and Max doing really well, 7 million subscriber gains. So even more importance on the bundling efforts that we're seeing across the board, especially as it pertains to sports. So we'll see what more comes there from Disney. Also here, the theme park business. This gives us a little bit of insight on where consumers might be pushing back on some of the prices for the experiences economy. This is incredibly important, even as you hear Disney talk about the capacity that they're looking to build out from years from now, and how they're going to make sure that they're engaging people coming into some of those parks experiences and the nights. So the night stays, the experience spending, and the average that people are spending when they're inside of those experiences as well. For all of you visiting the Disney parks and resorts, that's going to be in focus. And then just lastly here, advertising. Expect a little bit of slippage. According to some of the data coming into this, a lot of the consensus estimates are looking for a little bit of a year-over-year downturn in the advertising business here. But think about the election cycle as well. A lot of those ad dollars typically go elsewhere, some of the more political landscapes, channels, and carriers. And so Disney, within that regard, may see a little bit of slippage there. We'll see what the company has to say about a potential bounce back in that part of the business going forward. But those are the three keys to the House of Mouth that I'm watching. Shauna?
All right, Brad, thanks so much for breaking that down. Let's continue the conversation as we look ahead to Disney ahead of its fourth quarter results on Thursday. For that, we want to bring in Lucas Tamicki. He is the founder and managing partner at LRT Capital Management. It's great to have you here, Lucas. Walk me through your thesis right now. I know you're not too excited about probably what we're going to hear on Thursday. You haven't been too excited about Disney. Why not?
Well, good morning, and thanks for having me. Disney is really a combination of several businesses rolled into one. And you have one really wonderful business in ESPN, and that's unfortunately a business that continues to be a melting ice cube because more and more Americans are cutting the cord, and there's alternative ways to watch sports. And at the same time, the costs of the TV sports rights continues to go up because every year the NFL, of course, wants a little bit more money, and they just concluded a new contract for a lot more money. So ESPN, the margins are shrinking and the number of people paying continues to go down. And that's quite predictable as Americans move and more and more towards streaming. Then you have the movies business and the Disney Plus business, which frankly are not particularly great. I keep hearing from the bulls how Netflix, is terrible. They have bad content, and Disney has this wonderful content. What wonderful content does Disney have that they haven't acquired and paid for through the nose? Pixar, Marvel, and then Lucasfilms. What other content do they have that they haven't acquired? And of course, the Fox acquisition for $72 billion to get reruns of The Simpsons. So the content is not even that great. And again, they paid a lot of money for it. So I sure hope they make some revenue from these ridiculous Marvel films they come up with every year. And then you have the parks business. The parks business has been where all the action has been in the last several years. It's really carried the day, but it's a very cyclical business. And it's a much worse business than, say, the cable streaming business. Because in the ESPN business, when you have net income, all of that net income essentially is free cash flow. There's very little reinvestment required. but the parks require massive investment. So you had 7.6 billion in operating income from the parks over the last 9 months, but you had another 3.9 billion going right back into the parks. So the actual cash that you're able to pull out of that business is much less attractive than the rest of it.
Lucas, we only got 30 seconds left here, but as you think about the comparisons that Disney and all of the other streamers have up against Netflix as really being that North Star, when you think about them trying to get to the same type of margin proponent or even comparison, do you think that's possible?
Yes, I think it is possible, but I think it requires a complete rethink of how you create content and what is the definition of great content. People will tell you that The Mandalorian is great content at $5 or $6 million an episode. And I would argue to you that actually great content is Too Hot to Handle on Netflix, which is a trash reality show. But guess what? At the bottom line, what matters is that people keep watching and are hooked to your platform and are willing to pay for it. So the thinking has to change. It is possible, but we're not seeing much of that change at Disney yet.
I would argue that Love is Blind is better than Too Hot to Handle, but hey, who am I? Who am I? And I also don't want to upset those that are in the Marvel or even in the Lucasfilm universe out there, so I'll leave that to you. Lucas Stamicki, who is the LRT Capital Management founder and managing partner. Thanks so much.
Thank you.
Coming up, everyone, we're discussing more of the stocks that are making big moves this morning. Stay tuned.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds apiece. Let's go. First up, let's go to BYD. They could potentially sell more vehicles than Ford in 2024 after shipping a record 500,000 cars in October, bringing it nearly in line with Ford's sales for the year. Now, this comes as the Chinese automaker bested Tesla in quarterly revenue for the first time. Just to put a fine number on exactly how many vehicles they sold, 534,003 vehicles in October. It puts it basically in the same ballpark with Ford year to date here.
All right, let's take a look at Nvidia, the top-rated large-cap name from Piper Sandler. The firm raising its price target for shares ahead of its Q3 earnings results in a couple of weeks, citing the launch of its Blackwell chips and Nvidia's, quote, dominant positioning in AI as a couple of reasons to be optimistic. Despite all that, Nvidia giving back some of the gains here. Nothing to do with this call out here from Piper Sandler, but the analysts there are saying that they expect the total addressable market for AI accelerators to continue rising through 2025, in 2025, by around $70 billion. They expect Nvidia to be a huge beneficiary of that, while ceding only a small bit to its merchant chip competitors.
And finally here, let's go to a workplace software company where every day is a case of the Mondays. Monday.com trading lower after reporting third quarter results. The company saw total revenue increase by a third in the quarter, topping $1 billion in annual recurring revenue. Monday.com did raise its guidance for the full year. Shares, though, still down by about 17.5% here early in trade. They did note as well that the net dollar retention rate, that increased to 111%, and the second largest customer more than doubled their seat count. But still, investors are waiting for much more to come from this company, it seems.
All right, well, that does it for a morning brief, but keep it right here. Join me, my co-host, Madison Mills, for the next hour. We've got more analysis on today's biggest market catalysts. That's coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, U.S. stocks reach new highs with the Trump trade still in full swing. We'll break down how to position your portfolio for a new administration.
Plus, we'll have full coverage on one of the biggest Trump trades as Bitcoin tops 82,000.
And from Bitcoin to big tech, we'll take a look at what M&A and innovation could look like under a new administration. There's still one outstanding question from the 2024 election. Who will control the House of Representatives? Here with the latest, we've got our very own Ben Werschel. Ben, thanks so much for joining us this morning. If you take a look at betting markets, they're pricing in about an 80% chance of a full red sweep. What do we know so far about where the House race stands?
Yeah, those odds sound about right. So the magic number for Republicans in the House is 218 seats, and they have 214 seats at the moment. And of the 18 remaining races, the Republicans are ahead in 8 of them. So that gives you a good sense that they're on the inside track here for what's being called a GOP trifecta: the White House, the Senate, and the House of Representatives. And basically, the Republican leadership has already essentially laid out their plans, assuming they get this trifecta. And so what we're looking at now is sort of what the first 100 days of the Trump administration would look like, which could be much more active if Republicans are in full control of all those kind of levers of power in Washington. The big one that they're talking about is taxes. We've been talking about this, the tax debate coming next year. What a trifecta would mean is essentially the tax debate becomes less of a total Trump first year agenda item and becomes into a Trump first 100 days agenda item. It's a complicated process. Reconciliation is what it's called. But they're really aiming to kind of muscle it through quickly if they can get these last 4 seats. The other thing to underline is that these are any scenario here is a very slim GOP majority. 218 seats out of a 435-seat chamber is very slim, so there'll be a lot of debates within the GOP about their priorities, and anyone that's kind of opposed to certain tax provisions, for example, could raise their voice and have a lot more power there too. One other agenda item to flag is energy. That's going to be a big one for the first 100 days, assuming the GOP trifecta comes into place. The question being, the House leaders are already promising big bills to kind of open up fossil fuel drilling. The question is, how hard do they go against the green energy credits in the Inflation Reduction Act that Joe Biden signed into law? In other words, how much do they go after green energy versus support clean fossil fuels?
Yeah, Ben, I think a lot of that could also be told by who is picked for Trump's cabinet. That obviously has been something that has certainly been the focus over the weekend. Where do things stand now?
So we've only had a few. The one today is Elise Stefanik of New York is going to be the UN ambassador. That comes after Susie Wiles was named as the chief of staff. And Susie Wiles is the big one because that opens up kind of all the other positions: Treasury Secretary, Commerce Secretary, his Trump's major economic advisors on that one. So that's the one watching most closely here for Yahoo Finance. And those could be soon. Those could be this week. Those could be next week. Traditionally, it happens in November, so they could be very soon. And there's a lot of names there among Trump kind of loyalists, the could be there. John Paulson is one who's talked about Treasury. Scott Bessent is another sort of Trump loyalist who's going to be in the mix for something. So the economic folks are coming, and they should be coming soon.
All right, Ben, as always, great stuff. Thanks so much for breaking it down for us. Well, the outcome of the House races could have a substantial impact on policy and your money. Stocks extending gains this morning on the back of last week's rally post-election. Now, joining us now, we want to bring in Jay Pawlowski. He is TPW's advisory founder. Jay, it's great to have you here. So talk to us just about how you're looking at this euphoria that has swept Wall Street and whether or not this momentum to the upside still has some more room to run.
Well, it is very interesting, right? Last week, the S&P up about 4.5%. Bonds suffering a little bit, dollar stronger, commodities a little weaker. So the question is exactly that. Is there more to go for? I think there probably is for a couple of reasons. So first, you've had a collapse in volatility, and importantly, not just volatility for stocks, the VIX, but also the MOVE index, which is the volatility index for treasuries, has collapsed back under 100 this morning. From a high of 135 pre-election. And that takes us back to levels that were in place pre the bond market pricing in a potential Trump victory back in early October. So if the move in rates is going to subside for a while, I think that clears a roadblock for stocks. And so you have seasonality, which is very supportive. You're in the best 3 months of the year for stocks. You have a collapse in the VIX volatility. You have people who de-risked pre-election now have to come back in. And I think that's important because you're probably setting up for a chase into year end, right? Active managers tend to underperform. One of the reasons why is weeks like last week, where if you had any cash at all, you were underperforming because the market went up so strongly. And so now you set up that chase into year end. And so I think technicals are supportive. The one negative is that sentiment has gotten very positive very quickly, and that tends to be a warning signal. But from our perspective at TPW Advisory, we think the move for further upside, not a huge amount in the U.S., is there through year end. And then there's going to be probably a digestion period as people try to assess the likelihood of different policy measures coming out of the new administration.
So Jay, in terms of your investment approach heading into year end, how much are you positioning around that optimism, those animal spirits that you mentioned, versus any positioning changes that you might want to make under a potential red sweep?
Yeah, no, that's an excellent question, because that's another factor, as you just touched on earlier. Who are the Republicans going to control all three levers? And if so, then the policy mix probably gets a little bit more aggressive. And there, I think there is a question, right? So our view is that we're in the early to mid stages of what we call the long cycle. And that long cycle is a period from 2023 to 2027, where we expect to see a continuation of the equity bull market, which is about 2 years old. Average age gets to be about 5. Returns have been about 65%. Average returns over 5 years in a bull market tend to be 180%. At the same time, you have a global economy that's in pretty good shape, doesn't have any major imbalances, fully employed economies, pretty flush consumers. And so we expect continuity to be an important driver to sustaining that upside, that long cycle in both global growth and global equities. So now you have, with the Trump administration, potential for discontinuity, right? Policies are going to be different. And I think it's going to set up a push for faster adjustment in what we call the tripolar world. So in Asia, particularly China, going to have to respond here. And then in Europe, we think Europe is under a lot of pressure to respond from a strategic perspective on things as wide as trade, economic activity, defense with what's going on in the Ukraine. So it could be an acceleration of policy adjustment around the world, set off by what I think is a surprise to most folks, that President Trump has returned to office. So putting that all into a market context, we have been and remain overweight equities and overweight commodities. We see a global growth cycle being supportive for commodities, which have lagged a lot. We are very underweight bonds versus our benchmark and completely out of U.S. Treasuries. And so I think that the test here is going to be, policy mix for the Trump administration, tariffs, taxes, deportations, et cetera, all of which tend to be inflationary, versus a bond market that already is in a bear market and potentially could go higher, capping stocks. We don't see a huge amount of upside for U.S. equities over the next year. Third year of a bull market tends to be a rest year. Earnings growth is going to be the driver. Rest of the world, we've got the view we want to buy laggards. So rest of the world is cheap and under-owned. We look at places like China as attractive, emerging markets broadly. And then we think thematics, which we like a lot, things like fintech, crypto, cyber. These are some of the areas that are of interest to us in terms of laggards that haven't really participated over the last couple of years.
Jay, real quick, just going back to what you just said about commodities there a second ago, you're seeing some opportunity. I'm curious how you stack that up against the reflationary side of this equation and whether or not that could actually potentially be a headwind then to some of these trades.
Yeah, that's a great question. Commodities have been really not a good performer. They're at their lowest level in years, completely underallocated. B of A says institutions are at 7-year low allocations to commodities. And we think there's a nexus between the build out of AI, which requires a lot of power, and then some of the commodity space, things like copper, for example, things like nuclear power and uranium. Those are all really of interest to us. So we're in the minors in a number of these segments where we think there's going to be a real opportunity for growth as the AI build out really requires a lot of power build out.
All right, Jay, we got to leave it there. Always appreciate you joining us. Thank you so much.
Happy to be here. Good luck.
Thank you. Let's take a look at some market action to start off the hour here, sponsored by Tasty Trade. Stocks rising to kick off the week. This follows last week's rally, coming off their best week in a year. The market hitting 50 all-time highs year to date. Torsten Slok out with a note this morning talking about how the average all-time highs in a year, it's closer to 18. So heftily beating out the average here when it comes to gains. And you can see we're on track for more of those gains in the S&P today, though the Nasdaq under a bit of pressure when it comes to the tech-heavy index. But let's take a look over at Bitcoin after topping $82,000, still moving to the upside. Crypto stocks rallying on the back of this, as well as investors are betting on pro-crypto policies in the wake of Trump's election win. It's interesting to see the rally that we're seeing in a lot of these crypto names here. I want to talk about MicroStrategy because this morning the firm, Michael Saylor at the helm, very pro-Bitcoin, announcing that they bought 28,000 Bitcoin between October 31st and November 10th. That cost the firm over $2 billion, but we are certainly seeing it leading to gains for them. You can see MicroStrategy up about 13% right now. Now, coming up, we're looking at today's trending tickers. We'll give you the news behind the moves next, right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's with the Yahoo Finance's trending tickers page. First up, health insurer Cigna saying it is not pursuing a combination with rival Humana after reports that the two companies were again discussing a deal. Now Cigna saying it would only consider acquisitions that are, quote, strategically aligned, financially attractive, and have a high probability to close. Now, thoughts of this, or reports of this, rumors maybe at this point, of this potentially happening, of course, came after President-elect Donald Trump won the White House following the election. But Cigna saying that it remains committed to its established M&A criteria and would only consider those acquisitions, again, that make sense for their business down the line. So, again, these two health insurer giants, combined market value of roughly $125 billion. I think my takeaway is almost, we talk about how much the M&A landscape, Maddie, could potentially change under a Trump administration. And I think some of the pushback here from Cigna, and I don't think it only has to do with the regulatory environment. Obviously, they talk about the value of the deals and things like that and what ultimately makes sense for their business going forward. But I think it does maybe make me at least question what exactly that deal activity volume is going to look like. And maybe it won't be as dramatically of an improvement, if you want to call it an improvement, than what we had seen over the last 4 years, just given the fact that maybe there is still some hesitation of the larger companies that are looking to merge.
And as you mentioned, it's not just the regulatory pushback. We know from reporting over at Bloomberg News that the talks between these two did heat up following the election result, and yet it obviously was not enough. This is not the first time the two players have talked about a deal as well. They were in talks last year but couldn't agree over price, and now we are potentially seeing another challenge here, though. Having said that, Cigna also saying they're actively pursuing repurchasing shares in the fourth quarter and in 2025, so they're focused on those share buybacks as a way to put their capital to use moving forward here, and maybe that's one reason we're also seeing such a pop in those Cigna shares this morning. All right, next up, fashion company Moncler saying it will not comment on a possible takeover of Burberry, calling it, quote, unsubstantiated rumors. That's according to a report from Reuters. This comes after Daily Mail reports saying that Burberry is close to being bought by the brand that's known for its ski wear, among other things. I think it's interesting here. In September, LVMH, which is the owner of brands like Stella McCartney, they bought up about a 10% share in the owner of Moncler. So there was this speculation that Bernard Arnault, the French billionaire, was behind this move on Burberry, which makes sense given the conglomerate of other firms that Arnault has under his belt there. Burberry is also reporting on Thursday, so I wonder if we'll get more information from them about the deal, but it sounds like for now they're throwing cold water on these reports.
Yeah, it will be interesting to see how this all plays out. Again, I think you can make the argument that maybe teaming up of Moncler and Burberry could ultimately make sense, maybe, just in terms of expanding your reach and a more broader impact here, as the market does remain a little bit challenging. But again, there's lots of questions about whether or not this will actually come to fruition, and the fact that Moncler is also refusing to comment on this as well. Well, finally, Home Depot set to report third quarter earnings tomorrow before the opening bell as demand remains under pressure. Joining us now, we want to bring in Seth Basham. He is Wedbush Securities Managing Director of Equity Research. Seth, it's great to have you here. So curious what you're expecting to hear from Home Depot tomorrow morning.
Yeah, thanks for having me. We're not expecting too many fireworks in tomorrow's earnings report. We're looking for basically inline results for the third quarter and reiteration of the full year guidance. That being said, I think the company can point to some green shoots that will positively impact its business into 2025. And those really revolve around what's happening with housing. Existing home sales on a pending basis are improving, especially in the Western region. In addition, we're seeing improvements in housing affordability despite the backup in interest rates. And we also have more homes available for sale. So a lot of green shoots there that should help drive their business in 2025.
Seth, how much do you expect to learn from the call this week, just in terms of what any potential red sweep could mean for the company moving forward with policies from the likes of immigration to tariffs? It seems like there are several policies that this administration has teased out that could be headwinds for Home Depot.
Yeah, well, generally speaking, we expect positive inclinations from the Trump administration as it relates to housing policy, which is good news for these guys. But as it relates to tariffs, that's the biggest headwind. 60% tariffs on products coming out of China would be a material negative for Home Depot and most retailers that import a lot of the merchandise. We estimate about 40% of the merchandise that Home Depot imports or sells is imported, which would lead to a significant increase in cost for them and likely prices for the consumer. So that could create some demand destruction and reduce their comparable store sales. They'll also have to eat some of that increased cost. So how they navigate through that is definitely going to be a topic of discussion tomorrow.
Seth, I guess what is baked in then to your forecast just in terms of what you think is actually going to be implemented versus what has been raised maybe as a negotiating tactic from Trump's campaign?
Yeah, we haven't updated our estimates yet for the impact of tariffs. We have created a scenario analysis suggesting there could be over 100 basis points of margin pressure if they were to pass through all the increased tariffs, including 60% type tariff from China. But that being said, we think that that may not come to fruition for one, and for two, some of that extra cost will be eaten by the suppliers and not necessarily the company, and some will obviously be passed along to the consumer. So a lot of moving pieces to that, but it is an incremental negative.
I wonder, too, when you think about guidance here, to what extent you look at some of the economic data when you're building your own models to suss out the earnings results of a company like Home Depot. I think about mortgage applications down over 10% last week. How much does that weigh on your broader outlook for the company?
Yeah, we certainly consider those. While mortgage applications were down last week, we are seeing an improvement on a year-over-year basis, particularly in refinancing applications in the last month. Now, the backup in interest rates, again, has pressured applications in the very near term. But as we move into 2025, we're optimistic that we'll see an improvement in housing on the back of lower rates and lower, if not stable, home price appreciation compared to what we've seen before, and better availability of homes for sale. So put those things into consideration, and also consider the fact that there is so much pent-up demand for home improvement, with a lot of home equity being on the sidelines, ready to be spent on home improvement projects once those rates come down.
So talk to us just about how big of a boost you see that ultimately being then to the stock price.
Yeah, it is definitely a material boost. It's just a matter of when we get that unlock. Some of this has been factored into the stock price already, but to the extent that we see improvement in those underlying trends with those green shoots in regions such as the West as a leading indicator, we think the stock could continue to rally from this point forward.
All right, Seth, thank you so much for joining us. Really appreciate it this morning. That was Seth Basham. He is over at Wedbush Securities as the Managing Director of Equity Research. Coming up here, Bitcoin hitting a new all-time high as the Trump-fueled rally continues. We're going to dive into the latest moves in the crypto space next, right here on Catalysts.
Crypto rally is full steam ahead on Bitcoin. Now with Bitcoin topping $83,000 today. That was for the first time ever. You can see it even pushing, getting closer to 84,000. Our very own Jared Blickery has the latest on that move that we're seeing. Jared.
Yes, 83,000. It was 81 just an hour ago when I was preparing for this hit. Here's Bitcoin, and let's take a look at the price action over the last 24 hours, definitely from the lower left to the upper right. And let's just take a look at the last 10 days so we can see what's happened since the election. There's that nice post-election pop, and we are up 20% from there. What's the next target? It would easily be easy to say 100,000, 125,000, and of course there are much higher targets there. But we can see within the last 5 years the pattern really strong here. This big cup and a little flag there, not quite a handle, that we got this pop out of, and so that's a very long-term base. It's like exactly where the short cap market is today. Russell 2000 probably a few months ago. So we'll see if there's an eventual breakthrough there, but not to get too ahead of ourselves. Dogecoin has been on an absolute tear. This is also a 5-year chart. So here are the record highs north of 50 cents in 2021. We are right now north of 30 cents. You take a look at the year-to-date chart, and it has just exploded along with the rest of crypto and a bunch of other stocks since the election, up 235% year-to-date. And I'd be remiss if I didn't go over some of the crypto stocks as well. Two in particular I'm watching that have just hit $300 per share. And let's go by Coinbase first, a little bit bigger in market cap. Here's the year-to-date chart. Coinbase has exploded to the upside, really just exploded past this resistance at negative trend level there. And if we take a look at a max chart, which shows since the IPO, you can see we've basically come back to the beginning price. So almost all the way round tripping. That was kind of an ill-fated timing move for Coinbase because it happened to top tick the entire crypto market at the time. So Coinbase just kind of climbing back to break even here for some of those early investors. But here's MicroStrategy, just announced that it bought an additional $2 billion in crypto, 27,200 Bitcoin since the election, or since just before the election. And here's that max chart for MicroStrategy going all the way back to the early, that might be the late 1990s there, but we want to get a closer look. Here is a 3-month chart up 131%. And I should also note that MicroStrategy led the Bitcoin breakout. MicroStrategy was hitting record highs before we saw that big breakout in Bitcoin just prior to the election. That's when the MicroStrategy breakout happened. So all in all, I will be watching MicroStrategy to see if there's a break in the price, to see if things roll over, but we're definitely not seeing that yet, guys.
All right, Jared, thank you so much. Really appreciate it. For more on the crypto rally and the next catalyst for further upside, in studio, we've got Andy Baer. He is the managing director of CoinDesk Indices. Andy, it's great to have you here. So, okay, holding on to 83,000 levels, how likely is 6 figures by year end?
This is the last piece of the puzzle for Bitcoin in particular, right? Getting the ETFs launched, and now they probably have close to about 80 billion, 75, 80 billion dollars of AUM in the ETFs. Then getting the Fed, the easing cycle begun. That began on September 18th, and we were out saying that's a great start, right? We like forward real interest rates being lower. That helps support the Bitcoin price. Then regulatory was the third thing to fall, and the election just made that very clear that there's going to be both regulatory reform, hopefully some positive legislation, which helps the whole industry. So for Bitcoin in particular, really it's, all lights are green right now.
Andy, do you think the market's being a little bit too optimistic just in terms of what they're pricing in on the regulatory front versus what maybe be more realistic outcome?
Yeah, I think, the thing that we always have to remember about Bitcoin is those 5%ers, right? The people who spend 5% of their investment time thinking about Bitcoin. That's much less than me, and maybe the rest of the viewers are in that category. Many of them just really haven't engaged yet. So I think part of the upward pressure is that adoption will continue. It'll be Bitcoin, of course, there's a bigger breadth story, but that's one thing that other assets maybe that have capped momentum don't have. There's so much momentum possibility based on just the sheer fact that adoption is still at an early stage, and also that the president mentions Bitcoin a lot, right? The president-elect mentions Bitcoin. The current president doesn't mention Bitcoin a lot. just that kind of repeating kind of chorus of this is something interesting, I think will bring a lot of new people in, and we have a long way to go with a limited supply of Bitcoin.
So talking about Andy just bringing a lot of new people in, I guess here we are today, if we sit here a year from now, 2 years from now, what does that then look like and what does the conversation sound like?
Sure, I think for the first thing, and I hope many investors kind of sort of adopt this mentality, Bitcoin is its own thing, right? It is a macro asset, it's a store of value. It really doesn't do much but move from one address to the other, but it has a scarce supply and it has very good security and a 15-year network. So think of it as this singular asset. The growth in smart contract platforms, in things that will change the way we live, similarly to how the internet did and how mobile phones did, that really hasn't had much sunlight, right? I liked that 10-year chart of MicroStrategy because you showed 1999. 2021 was crypto's 1999, right? That first kind of overshoot of enthusiasm that got toppled like tech stocks did in 99. Now we feel like, well, crypto moves a lot faster. We didn't need 10, 15 years to come back, just a couple of years. The rest of the tokens, and you've seen them in the price action over the last week, the breadth has been incredible. Solana and Ethereum and Uniswap, DeFi, smart contract platforms, Chainlink, which supplies the decentralized universe with data and information. All of these names have done well. The CoinDesk 20 index, which captures a lot of these things, which is our benchmark, is up 30% since the night before election. So it's been a breadthy rally that we think has a lot of legs because, again, a lot of these technologies are new, and then many people don't know about them.
Given that, I wonder how you view the rally in altcoins, and is it potentially doing the opposite of what you're talking about, which is like this idea that the altcoins remind people of FTX, of this kind of schoolboy mentality in the crypto community, instead of, hey, look over here at Bitcoin, this is actually something the president's talking about.
No, I think that's a very good point, and it's important for investors to realize that once they get past Bitcoin, they have to learn a lot of new stuff. Ethereum works very differently from Bitcoin. So to the extent that starts to concern them, as if, I don't know, if Ethereum or Solana is going to be the primary layer one, it's too complicated, I don't want to token pick, go for an index investment, right? And a lot of investors around the world have taken in our CoinDesk 20 index in a variety of forms so they don't have to choose. It's like a QQQ of crypto. And that kind of alleviates concerns about individual tokens having issues. One of the things that we hope for is that in the United States, investors will have the same access to index investments, and that will be the first good defense against individual tokens having problems.
Andy, I don't know to what extent you can comment on the pricing here of Bitcoin, but we've had a lot of guests come on talk about 100,000 is in the cards. We had one guest come on talking about the fact that if everything falls into place, we could be talking about 200,000 in the not too distant future. How should investors be thinking about the trajectory here, how dramatic the climb has been, and maybe ultimately what that signals about how much more room there is to go?
For sure. So Bitcoin's, if you think of its return distribution, it tends to melt up, not melt down, right? And that is seen both in its options market, but also just in its return distribution. So these kind of melt up moments, which are usually categorized by news coming out and trend signals, tend to have legs, right? Again, the essence of trend, one of your earlier guests said this, is that more people find out about the same news and they get on, in stages, right? We have the 5%ers who, most of whom are not even engaged yet. So momentum can have legs. Our trend indicator is pointing to a significant uptrend. I think there's more good news to come out. Remember, we're still in an easing cycle from the Fed, and there's still concerns about inflation. Both of those things are positive for Bitcoin. So I don't necessarily think like another 20, 30, 40, 50% move is out of the cards. Bitcoin proves over and over again that it's totally capable of doing that, despite being a $1.5 trillion asset.
It's good to have both of those things happening at the same time, right? You're good if the Fed cuts, you're good if inflation stays high, good place to be. Andy, thank you so much. Really appreciate it. Andy Bayer in studio with us. He is CoinDesk Indices Managing Director. We'll have all your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalysts.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Oil extended its biggest drop in almost 2 weeks as soft demand outlooks for China and a stronger dollar continue to weigh on the outlook for crude. Our very own Inez Frey has all the commodities news that you need to keep your eye on this week. Inez, thanks so much for joining us here. What charts are you looking at?
Yeah, I'm checking out the oil chart right now, as you just mentioned, Madison, because we are seeing some pressure to the downside when it comes to WTI, down more than 3% during the session, and Brent crude also lower, down more than 2.5%. A lot of this has to do with that strong dollar. When you see the dollar index going higher, that is bearish for oil because oil is priced in dollars. But you also have something going on with respect to this post-election rally that we've seen in assets and what's happening here, because there are analysts that are predicting that if Trump is able to end the war in Ukraine, if he's able to also convince Israel to end the conflict in Gaza as well, this will mean easier flow of energy products throughout the region. This will mean that that risk premium that we have seen in commodities in the oil markets will be going away. And then you also have what's happening in China China and China stimulus disappointing investors, and whether you are going to see the economic growth that investors want to see coming out of China, because China is the biggest importer of oil. So a lot of these pressures are now in the oil markets, and we're looking at WTI that's down for the year. It's been a volatile year, needless to say, for oil, but this is just adding to some more of that volatility, guys.
Inez, let's talk about the trade of gold, because I think this might have caught some people a little bit by surprise, maybe not so much. I don't know, it depends how you look at it. But we are looking at gold continuing to be under a bit of pressure. Walk us through why that is the case following the election of Trump.
Yeah, so you've got a couple things going on. You have some analysts that are saying that if you do see a trade war with China, this is going to be bearish for oil. You've got the dollar index again. If the dollar goes higher, this is definitely bearish for gold, as we've been talking about the other commodities as well. So you're looking at gold that's down more than 2.5%. When you're seeing treasury yields going higher, that is bearish for gold as well, because gold does better when you are seeing the rates coming down and treasury yields going lower, because that means that it doesn't have to compete for other high yielding assets, because gold doesn't give you a yield, a yearly yield, like some other assets do. So you're looking at these metals that are coming down. Silver also down more than 2.5%. But look, these have been some overextended rallies as well when it comes to these metals. You're looking at silver that's up 28% year to date. Gold is still up 27% year to date. And you still have analysts that are predicting that it's going to go higher. But temporarily, we are seeing this move lower, guys.
All right, Inez, thanks so much for breaking that down for us. Coming up, we're discussing the impact of a second Trump presidency on the tech industry. We've got that for you when we come back.
Are you a passionate investing bull? Maybe love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Following President-elect Trump's victory, multiple tech executives congratulated him, including Meta CEO Mark Zuckerberg and Amazon Executive Chairman Jeff Bezos. But what will a Trump presidency mean for these major tech firms? Ronnie Mola, Sherwood's senior correspondent, is joining us now to break it down. Ronnie, it's great to have you on here. So talk to me about what you've heard from tech executives following this election and what you make of how it's actually different than what we've seen from prior election results. We didn't necessarily hear congratulations from the likes of Zuckerberg and some of these other CEOs.
Yeah, it's definitely a different situation this time around. Back in 2016, tech CEOs were sometimes openly combative. They, or at least more ambivalent than they are this time around. This time, they're all sending their congratulations on Trump's decisive victory. It's kind of like ChatGPT they all prompted ChatGPT for the same response to publicly and then privately talk to Trump. And I think that has to do with just knowing a lot more this time around, knowing what happened during his first presidency, knowing that he could hold a grudge, that he can be very vindictive. This time you see them just sort of getting out in front of it, being much more pragmatic and saying, how can we at least not upset Trump and maybe get on his good side?
Ronnie, I'm curious from your reporting, what do you think a second Trump term, what does that mean for some of these Mag 7 names?
I mean, it's so uncertain. There's some things that are clear. For Tesla, you have Elon Musk, who has put his billions and his platform behind helping Trump get elected this time. He was one of the biggest donors. He and Tesla and his companies stand to gain a lot from this. You've had Trump say that he would have Elon Musk be a secretary of cost cutting. Elon Musk has said that he would cut $2 trillion, maybe a third of the federal budget. You could definitely see a world in which Elon Musk would use such a position. There's a lot of ifs here. If this actually happens, if they do what they say, but where he could use such a position to cut regulations that are stifling his own companies. You have his SpaceX, shooting rockets into outer space, and you have Tesla hoping to have autonomous cars, but running into a lot of regulation on a state level that is keeping that from, going through from being legal. So you could see him cutting in that sort of direction. There's also a lot that these tech CEOs stand to gain or lose based on AI. They've spent a lot of money, a lot of investment in AI, so less regulation in that department could be helpful. There's also Trump's tariffs. You have Apple CEO Tim Cook enjoyed a pretty good relationship with Trump the first time around in 2016. They were not subject to some of the same China tariffs or same tariffs that other companies were. But this time around, there's supposed to be a 60% tariff on goods produced in China. And we know that Apple makes half of its revenue from iPhones, and iPhones are produced in China. So it remains to be seen what's going to happen there. And Tim Cook has, said he wasn't going to speculate.
Yeah, and Ronnie, it's interesting because I wonder if there's any data point that you've seen, I know you love to look at the data, that indicates that maybe the market has gotten a bit over its skis here with enthusiasm about what a second Trump presidency could mean specifically for those tech names, not just given some of the macro factors that you mentioned in those policy factors, but also you noted that the Trump 1.0 wasn't necessarily super favorable to big tech. We did have regulation for Google, for Facebook. So again, is there anything standing out in your reporting that just points to this idea that maybe there should be a little bit more hesitation on the market side of things here?
I mean, so far it looks like these companies, overall the stock market is doing really well. Investors seem to be assuming there's going to be less regulation. And as you said, we really don't know. It wasn't as if the first Trump administration didn't have regulation. We just really don't know. I would say overall, stocks doing really well. Tesla doing very, very well. You saw it just surpass $1 trillion. I think we just have to see what actually happens when Trump gets into office.
All right, Ronnie Mola, thanks so much for taking the time to join us here. Sherwood, a senior correspondent.
Thanks for having me.
Let's hone in now on the battle for AI dominance and take a look at what innovation will look like under a second Trump administration. For that, we want to bring in Sultan Megji. He is the Frontier Foundry co-founder and CEO. Sultan, it's great to have you back here on Yahoo Finance. We were just talking with Ronnie just a few moments ago just about what ultimately a second Trump presidency means for big tech. I'm curious, specifically zeroing in on AI. Lots of talk about right-sizing regulation, what exactly that changing landscape is going to look like. What are your expectations for that?
Well, it's interesting, was listening to your previous guest, and if you compare the end of the Obama administration moving into the Trump administration versus what we're about to go through right now, the Biden administration has had a much stronger, much more aggressive regulatory regime, especially in financial services and healthcare. And so even if we just go back to something that looks like a Trump 1.0, and I actually think they'll go farther than that, it'll still be quite a big swing. And as it relates to artificial intelligence, it's actually been hampered in both of those markets by the current regulatory environment. And so I think, there are a lot of people who think it's, I heard the phrase over its skis a little bit. I think there's a lot of enthusiasm, but I don't doubt at all that by the time we get to, let's say, the second quarter of next year, we're going to see significant right sizing of regulation across the entire federal bureaucracy that will give the AI energy in the market right now even more leg.
What will that look like then moving forward? Because it's kind of hard to suss out, given that we did see some regulatory pressure from the Trump administration the first time around on some of these big tech names. So what will be different this time?
The way I would phrase it is it's going to be much more about using these technologies as growth measures for the economy versus things to be managed. There's been a real sea change in thinking amongst a lot of people in tech, and it's definitely gotten into the Trump campaign and into the Trump transition team, that technologies like artificial intelligence, technologies like crypto are fundamentally things that should be built and sold out of the United States, both for our own use here, but also globally. And that it is a huge opportunity for the U.S. And I would draw a parallel with the manufacturing growth of the late 1940s into the late 1950s as a fundamental growth of the U.S. economy. And the only way to keep this whole system moving at the clip it's going is to create more of that growth. And I think a lot of the economic advisors around President-elect Trump really do understand that.
So what about the immigration component to all of this? And given what we know and what Trump wants to do or what he has outlined in his campaign trail when it comes to the immigration czar and the mass deportations, how big of a headwind and a challenge do you see that being just in terms of potentially stifling some innovation here within this country?
It's a huge issue, right? So if we broke it up into two parts, one is we want here in the United States the best and the brightest, right? So you want a strong, proper legal immigration program that allows for the next generation of innovators to come here and build what they're going to build here in the United States. The other side of it is within all of the different components of Homeland Security, they've had thousands of jobs open for forever and are having struggles to find them. And so I think, for me, it comes down to what are they actually going to legally be able to do? And then how are they going to execute against that? And again, I think there's a kind of an interesting opportunity for the tech community to help with the immigration program by just making it run more efficiently. There are a lot of great programs out there that I don't think have gone as far as people would like in terms of using technologies to speed up the immigration process, to speed up the management of illegal immigration, to speed up finding things like counter narcotics and fentanyl at the border. And so there's just a huge target of opportunity. And again, I think there's a lot on the president-elect's plate, regardless of what the final makeup of Congress ends up looking like. It just won't go nearly as quickly as I think people want.
I'm really interested in that, and we only have a minute here, so I have to pick from the many follow-up questions that are coming to mind for me on that. I guess I wonder, I've heard a lot of folks and founders talking about this idea that tech is going to be the savior here, regardless of what policies are coming into play. And I wonder how you pair that thesis with what we saw from the likes of Elon Musk over the course of the presidential campaign, where we're seeing parts of the tech world moving closer to the policy world. How are you thinking about that?
There is a fundamental pragmatism that exists now within the tech community that I don't think has been there for quite a while. There is just only it's almost like a zero-sum solution, right? You are either going to grow or you are going to fail. And that is the thesis of a lot of tech companies right now, especially with the post Silicon Valley Bank collapse and this kind of reframing of what venture capital looks like. that entire conversation has changed. And I think there's a tremendous pressure on the entire tech community to show direct value in a really short amount of time. You know, a 3-year billion-dollar investment that doesn't show anything isn't going to cut it anymore. You know, it's okay, I put $1 in this year, I'd better have $3 of ROI out next year. And that realism, I think, is the real pressure we're seeing here.
All right, Sultan Meji, thank you so much. Come back so that we can talk to you about the debt ceiling next time and other things too. Really appreciate it. Thank you so much.
Great to see you guys.
Thank you. Now coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll talk about how to play this post-election market and the rally heading into year end. We'll see if it's got legs. And it's Veterans Day, folks. Happy Veterans Day to all of those who have served. And we're talking about investment opportunities that are aligned with the veteran community and tips for veterans who are current or aspiring small business owners. Plus, President-elect Donald Trump has won a second term in office. We'll speak to an expert about what his presidency means for President Biden's fight to secure student loan relief for millions of Americans. And we've got a quick programming note as well. Be sure to tune in to the 2024 Yahoo Finance Invest Conference tomorrow, November 12th, starting at 8:30 a.m. Eastern Time. But first, let's take a look at the markets and some of the action that we're seeing. 90 minutes into trade here on the day. Stocks right now, they are trading higher across the board. The Dow, the S&P 500, and the Nasdaq all seeing fractional gains, flat as they may be for the Nasdaq. For more on how investors can position their portfolios as we look ahead is Ben Gutteridge, who is the Invesco portfolio manager. Ben, great to have you here with us. All right, so as we're thinking about the rally that we've seen post-election here and whether or not this could set us up for a Santa Claus rally even, what are your anticipations as we look to close out the year and some of the themes that you think may carry over into 2025?
Well, look, I mean, it's only natural for markets to sort of check themselves, take a pause for breath. It's been a red hot run for much of the US equity market. But we think a lot of that is built on sound fundamentals. I mean, regardless of the sort of political outcomes that we've just seen, we've always sort of felt the US economy was extremely dynamic. But we also felt that you were getting a nice combination of resilient growth, fading inflation, and increasingly more accommodative monetary policy. Now, I know it can be keenly debated about, how much easier policy is going to get, but we still think we're in a cutting cycle. But anyway, that sort of trifecta, to use it in this circumstance, is quite a powerful mix for equities that could support us into year end and beyond, we believe.
What are some of your favorite sectors then with that regard?
Well, look, I think I don't want to be sort of too on the fence here, but we're thinking about portfolio construction. We're thinking about a barbell. I think it's hard to dismiss the appeal of that sort of loosely defined technology sector. That's such an innovative sector, such incredible earnings power. And indeed, the disappointment for one company, maybe spending a little bit too much on CapEx, is of course good news for the next, given it is sort of the picks and shovels of AI. So look, we still like that technology sector, and in a higher for longer interest rate environment, clearly they don't have any immediate financing challenges either. So not a headwind for them. But the barbell, the portfolio construction that I'm talking about, is alongside technology, looking at names like within the financials sector, a steeper yield curve environment, good news for loans. They can charge more for the loans. The growth impulse that we're sort of seeing and enjoying, that's better for the quality of that loan book. And maybe, although it's a tricky one to navigate politically, there is a deregulation story there as well. So valuation's clearly not so challenging in that part of the market. So sort of a technology, financials barbell looks like quite a sensible construct to us.
When you think about your own construct and as you're managing portfolios right now, what percentage of that portfolio construct do you think is weighted towards the U.S. versus other parts of the world?
Well, it's the dominant part. Of course, it depends on your domicile. We're sort of looking at international investors within our world, and so it depends where you're coming from, where your portfolios are domiciled as well. But it's got to be the most substantial part of an equity allocation. We know for US investors it's such a huge part of the benchmark, but it's not the case everywhere. But for the international audience, it is certainly needs to be the dominant part of an equity exposure. Perhaps not getting quite as far as 65% as you see on sort of an MSCI World metric, but certainly pushing half the allocation.
And the reason I ask that is because we've seen as well over the past few months a trade that is really more minded around what the stimulus efforts put into the Chinese economy may look like, or additionally something that you pointed out within your notes, US or UK equities rather, and UK long bonds and what that type of hedge is relative to the US as well. So, as you're thinking about those other kind of international mindsets that may prevail for some investors out there, how much of that has perhaps a long tenure in your portfolio, similar to what you're talking about as US tech?
Well, I mean, yeah, it is sort of all eyes on the US, isn't it, at the moment? So we mustn't forget there is plenty of opportunity elsewhere, notwithstanding, as I said, that we think the US equity should remain the dominant part of portfolios. certainly UK equities, an unloved part of the market, valuations looking very interesting, lots of dividend, lots of buyback, and some very low expectations about what growth can do here. So that's not such a hurdle to overcome. So that looks interesting. Of course, on the Chinese emerging markets, that China stimulus story, we do think a line in the sand has been drawn here. There's clearly an amount of pain that has been reached that the Chinese policymakers don't want that to go any further. But we're yet to see the detail, I think, to sort of really satisfy markets that the return profile looks sufficiently compelling. But I think there's asymmetry. We do think there's asymmetry in emerging market equities at the moment. As I said, that line in the sand looks to have been crossed, could be volatile, but on a medium-term view, expecting some more color on policy and expecting it to do more to help the demand side of the economy. Therefore, there is opportunity within emerging markets as well.
Ben Guthridge, who is the Invesco portfolio managing, joining us here on Wealth Today. Thanks so much for the time, Ben. Appreciate it.
My pleasure.
On Wednesday, we will get the Consumer Price Index for the month of October, known in your neighborhood as simply CPI. Yeah, the aggregate of indexes, it measures the monthly change in prices for a variety of goods and services paid by U.S. consumers. Headline inflation rose 2.4% on an annual basis and 0.2% on a monthly basis in September. While we also measure something called core inflation, which is that same headline number, but it strips out prices for food and energy, which are also considered volatile. Now, core CPI in September, that was 3.3% year over year and 0.3% month over month. Inflation by either measure is above the Fed's target rate of 2%. So which items or services have proved sticky in the Fed's fight against inflation? Well, shelter. It's been one of the biggest. The prices there rose 0.2% in September. Also, food prices were up 0.4%, and together those two indexes contributed more than 75% of all the monthly increases in that headline 2.4% figure. Now, motor vehicle insurance, that rose 1.2% last month alone, and prices are up more than 16% from a year ago. And, oh yeah, since you're probably thinking about this one, egg prices, they're up nearly 40% from a year ago. Wednesday's release will provide updated figures for these specific items. And overall, Wall Street is expecting prices to rise 0.2% month over month and 2.6% year over year, the latter of which would represent a slight acceleration in the headline figure. On a core basis, Wall Street is expecting prices to rise 0.3% month over month and 3.3% year over year, both of which would be unchanged from the prior month. Analysts at Goldman Sachs out with a new note, writing that markets have priced in one of the largest month-on-month reflationary shifts since 2000, and that those odds grew last week following former President Trump's victory. Here to break down what reflation is, we have Yahoo Finance's Catalyst co-host, Madison Mills. All right, so it's got the attention of Goldman Sachs here, Maddie.
It does, and for good reason, right? You mentioned that stat, markets repricing the risk of reflation at the highest rate since the early 2000s. Let's run through what reflation is, and then I'll explain why we're at risk of it right now. So reflation, it's typically when prices return to a previous rate of inflation. You can see from that definition on your screen here from Investopedia, though, it's typically done purposefully, right? It comes on the heels of a fiscal decision from the government or a monetary policy move from a central bank that is looking to expand and grow the economy. So this is something that could be done, for example, in parts of Asia right now, where we're seeing a lot of economic downturns. Reflationary policy moves could be used to spur up growth. That's not the problem in the United States, obviously. Brad, you just ran through all of those CPI inflation data, right? We are in a period of inflation that the Fed has been actively fighting against, and now we are at risk of reflation. That's something that Neil Kashkari talked about over the weekend, saying that we are still needing to work to get inflation back down to that 2% level. And here's the reason why. There are two reasons, according to Goldman. They talk about the economic data pointing to reflation, but they also, of course, talk about the Trump presidency. This is something that those dozens of Nobel laureates for months have been warning voters about, the idea that a Trump presidency would cause further inflation. Goldman Sachs has also been saying to buy gold as an inflation hedge under a Trump administration for months. So reflation, yes, it could be bad news for consumers who are concerned about inflation, which we know to be true. Over 90% of voters cited inflation as a key driver of their decision on who to vote for. But Goldman does give some positioning ideas for investors who are worried about reflation. So I want to run through a couple of those trade ideas. They talk about puts on the US dollar, calls on US fixed income. We continue to see the rally in yields. They also talk about having puts on US banks and financials. But going back to my point on yields, they do warn to watch what we're seeing in treasuries. If we continue to see a rally when it comes to the 10-year, for example, that could potentially put pressure on equities moving forward, which, as you know, we just saw markets hitting another 50th, I believe, all-time high for the year. The average, I believe, is around 18. So definitely outpacing the history here when it comes to market gains. So watch this space when it comes to treasuries as a potential risk moving forward.
Absolutely. Great breakdown of some of the things that are crossing Goldman's desk and certainly within their watch list for the potential trade going forward here around reflation. Thanks so much, Maddie.
Thanks, Brad.
A special programming note, Yahoo Finance's Invest Conference is tomorrow, November 12th, Tuesday, starting at 8:30 a.m. Eastern Time. It's going to be a packed day, action-packed, full of live interviews, some top-notch economic minds moderated by Yahoo Finance's editorial team. And here with more, we've got Market Domination co-host Julie Hyman with what you can expect to hear tomorrow. Hey, Julie.
Yeah, and some of it's going to come from you and me as well. We are emceeing the event. We're really excited to host this conference. It's our big annual conference. It kicks off with a pre-show. Our executive editor, Brian Sazzi, is going to be hosting his podcast, Opening Bid, from the event. Then at 8:30, we'll have our official pre-show, just one pre on that one, with our own Shauna Smith and Madison Mills. And of course, we'll bring you all the market news that you need to jumpstart your day. We're then going to kick off that stellar guest lineup. Mark Rowan in the pole position there, CEO of Yahoo Finance's parent company, Apollo Global Management. And then I want to highlight a few other of our guests, Brad, who I'm particularly interested to hear from. One of them is Bank of America CEO Brian Moynihan at 1 p.m. Brian Sazzi is going to be speaking with him. Why am I particularly interested in hearing from Moynihan? Well, as you know, there has been a lot of attention on the banks. Yeah. Because of, in this sort of post-election period, the assumption being on the part of the markets that the regulatory environment is going to be more friendly to the banks. Meanwhile, what's again perceived as sort of incoming President Trump's pro-growth policies also seen as benefiting from the banks. We'll see what Mr. Moynihan thinks about all of that. Yeah. So that's going to be really interesting. Then at 1:40, I'm going to be speaking to Margaret Anadu. She is senior partner at the Vistria Group. She heads up the real estate strategy there. A lot of affordable housing investment. And as we know, we're in an affordable housing crisis here in this country. She talks a lot about folks who are rent burdened, who are paying more than 30% of their income on rent or on housing, right? As she mentioned to me in our discussion ahead of time, a lot of people in the New York City area definitely fall into that category. So she's going to be talking about that issue and investing in that area. And then at 2 p.m., we've got Minneapolis Fed President Neil Kashkari. That's going to be moderated by Yahoo Finance's Fed reporter Jennifer Schonberger. He made some headlines over the weekend discussing the effect that, again, President-elect Trump's promised deportations, what effect could that have on inflation potentially? So that's going to be a really interesting conversation. But those are only three. It's going to be a full day. I know. It's going to be really interesting.
Action-packed. I don't know if they'll let me channel Jimmy McMillan during the conference, during the summit itself, when I intro your conversation that addresses rent as well. But the rent is too damn high, and so I'll say it here so that tomorrow, hey,
in case you can't,
in case I can't.
You said it already.
In case it gets vetoed from the script. Thanks so much, Julie. Looking forward to it. Everyone, again, be sure to tune in to the 2024 Yahoo Finance Invest Conference tomorrow, November 12th, starting at 8:30 a.m. Eastern Time. And coming up, in honor of Veterans Day, we have tips for veterans looking to start small businesses and how you can find investment opportunities that align with the veteran community. That's coming up.
Are you a passionate investing bull? Maybe love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Today is Veterans Day, and in honor of our American heroes, we're talking about how to find the best investment opportunities aligned with the veteran community. Here with more, we've got Kaj Larson, who is Siebert's Head of Military Investing and Communication. Great to have you here in studio with us, and a happy Veterans Day to you as well. Tell us about your dedicated military and veterans division and really how it works.
Yeah, well, part of the principle of devoting a portion of our company to serving those who have served, and it's not just military, it's really anyone who's worn the cloth of the country, first responders, law enforcement, people who have served their nation, we think they have unique financial circumstances. For example, my first combat deployment, I took a bunch of 18-year-olds to war. After 20 years, they retire at 38 years old, and so they have a full retirement from the service. But yet many of them go on to have second and sometimes even third careers. So their investment portfolios need to be appropriately allocated for that level of risk in their particular situation. We think the people who are best served to help them invest and manage that are those who have actually walked in their boots.
So what are some of the early conversations that you were having, especially when, and that's a remarkable age that you were mentioning, 38, that it's retirement and then trying to figure out, okay, what is next? Because there's still a lot of life left, and trying to understand, okay, what are the investment opportunities I can tap into? How are you both educating and then setting people up for success?
Brett, I think you nailed it. The first and foremost, the most important thing is to, what we say, dominate the information battle space. There's this kind of like large knowledge and wealth gap that seems to occur between the military and the civilian community. So the very, very first tactic that we're trying to use is to close that wealth or that knowledge gap, and to educate and to illuminate all of the benefits that are available to those who have served the country. For example, there's an Office of Financial Readiness. So some of these institutions exist within the military, but some of them also exist outside the military. So we want veterans and members of the military community to be able to leverage all these resources, both internally and externally. So within DoD, things like the Office of Financial Readiness. Outside of DoD, nonprofit institutions like the Guild Foundation that's devoted to financial literacy, or companies like ours who particularly and specifically serve that segment of the market.
What are some of the financial challenges that you hear from veterans when they are making that transition and trying to not just assimilate, but also thrive as well as they're getting back into community and getting back into money management as well?
Yeah, well, I think we hit it in the beginning of the segment that knowledge gap is really the first and foremost. Like, you have to educate yourself. There's a lot of benefits that need to be maxed out or that should be maxed out for veterans. Now, look, I'm not saying that, the $150 combat pay that I get to jump out of a perfectly good airplane is going to make anybody rich, right? But knowing in cumulative all of the benefits that you've accrued during your service actually can help you do really well. Relative to their socioeconomic peers, military members actually have a large amount of discretionary spending. That's because things like healthcare and often housing are covered, right? And so what we're trying to do is to get those people to take all of those incumbent economic advantages that they do have and maximize them through what historically gives you the greatest return, which is investing.
All right, so you've got some actionable tips, and we want to set folks up for success here as well. What have you found worked for you, as well as others around you, as you really look to make sure that you're taking more of the reins of financial management, investing, and even setting up a career path, should you so choose, thereafter service as well?
Well, to continue with the theme of dominating the information battle space, I personally transitioned. I went to graduate school after my active duty time, and that was an amazing soft landing, not just because of the knowledge I accrued, but because of the people and the networks that I developed. And so I always recommend education in some form as a really helpful aspect of veterans' transition. Beyond that, kind of good, sound principles of investing in money management. Just like we wouldn't go to war with one bullet in our gun, right? You want to have a diversified portfolio when you're investing. And so we encourage our military folks to use all of those tools and to have a diversified portfolio. And just like in war and in mission planning, we have contingencies. We also recommend that military folks have contingencies, right? You need that emergency rainy day fund. And then finally, the other thing that I would say is I encourage people to invest in what they know, right? Products and companies that they are familiar with and they think have good over the horizon potential for growth. So for military folks, we actually use quite often, are very familiar with more than their civilian counterparts, with a lot of defense tech and platforms that assist the military. And so because we have intrinsic knowledge of those companies and those tools, I think it gives us a sort of competitive advantage in analyzing them. And so I've seen the military community invest deeply in some defense tech companies, and they've done quite well in that space where defense tech is having a moment right now, as everybody knows. And so, again, sticking with that intrinsic knowledge that you have, I think, is always a good strategy.
Kaj Larson, who is the U.S. Navy SEAL veteran and Siebert's head of military investing and communication. Appreciate your service. Thanks so much for taking the time here with us.
Thank you.
Absolutely. According to the U.S. Small Business Administration, veterans own more than 1.9 million businesses and employ 5.5 million Americans. But the road to building a successful business is littered with challenges. Joining me now in studio to break those challenges down, we've got Elizabeth Gore, who is the co-founder and president of Hello Alice, live in living color in studio with us this time.
It's good to be with you.
Thanks so much for taking the time here. So, and we got to remind folks, this is a free online platform that allows people to launch their businesses and grow here. As you think about some of the challenges that we were just discussing that veterans face as they are coming out of service and then looking to start that next career path and start businesses, what do you commonly hear, and what are some of the tactics that you've heard this community lean into as well?
Well, I have to start with at my own kitchen table. So my dad is U.S. Air Force. I'm so proud of him. Happy Veterans Day, Dad. But, just like him, when he stepped out, he then started his own business and unfortunately got declined for substantial credit loans for his business. And so when we look back and we think, okay, what's going on here? You have highly trained individuals with great leadership. So why aren't they getting the credit and the loans that they need? And what we found is a lot of U.S. veterans don't have credit history. It's not that they don't have bad credit. And so what we're trying to do is ensure that we are talking with the banks, talking with different financing folks, really digging into new sets of data to ensure that we are funding the 2 million small businesses that are U.S. veteran owned. What
are the conversations that you hear about between veterans who are looking to get a loan and start their businesses and the banks themselves that are trying to make sure that not just is their credit worthiness, but of course that there is a sustainable business plan that they can evaluate and say, okay, we feel confident giving you this loan and seeing your business through to success?
Well, the exciting part is that on our platform, we serve 1.5 million small businesses, 150,000 of them are U.S. veterans. 90% of them tend to come to us with already having a strong business plan.
That's great.
And to me, that is indicative of our U.S. veterans and their ability to launch, lead, train, and so on. Now, what we need to do is then translate that over to, look, not everyone walks into a bank anymore and develops a relationship with that banker sitting across them. They're applying online, they're not presenting their business plan, and things are just going off of a FICO score. So what we've got to do is get U.S. veterans and military spouses to walk in, establish a rapport, or look at the SBA, look at CDFIs. There's different ways. I also love grants. We've talked about this before.
We did, yeah.
There are millions of dollars in grants for U.S. veterans and military spouses to start their businesses as well. So we really have to figure out how, one, to push institutions to be more veteran friendly, but also help these veterans apply to where they're going to get a yes.
So let's talk about that a little bit more. And the grants that are available, how do you go about locating those grants, especially if you know, hey, my background, my experience is applicable for this grant and you qualify for it?
Well, on Hello Alice, we have a financing center where we help you scrub the internet for great grants, particularly for U.S. veterans. Additionally, if you go to the SBA, sba.gov, you've got to really dig in there, but you can find them. Finally, look at Veterans Affairs, look at DOD, as far as government institutions that will help you look for those grants. And then there are great nonprofits, Bunker Labs for Veterans, Syracuse University, the AMSI is the Association for Military Spouses. So all of those organizations will also help. One other tip, though, I think it's really important, is the second you start your business, filing with the SBA to get your U.S. veteran-owned business number. That's very helpful on discounts, on getting a leg up on your applications. And then there's a separate registration for a disabled U.S. veteran-owned business. So other benefits there. So we have a very large disabled veteran-owned population that's coming back from wars right now, and we need to ensure that they are also funded.
There's one other tip that you told us about as well, which is making sure that your business has diversified revenue streams or multiple revenue streams.
Yes.
Why is that so important?
Well, right now, small business owners, we're excited, right? There's 5 times the amount launching in our country, but capital is very expensive right now. And so that really doesn't match up. So I really look at folks and I say, particularly our U.S. veterans, really think about your small business lending, your loans, but also look at operational credit. Actually, veterans tend to use credit more efficiently than civilians, which is really interesting. So operational credit is a really smart way. Lean into your cash flow. There's nothing better than your funding coming from your own customers.
Right.
So maybe don't grow quite as fast and use that cash incrementally to grow, but really look at 3 to 4 sources of capital when you're starting your business.
Elizabeth Gore, who's the co-founder and president of Hello Alice. Great to see you here in
Great to
studio.
see you.
Thanks for taking the time again.
Thank you.
And a special programming note, Yahoo Finance has teamed up with Patrick Murphy, former congressman, the 32nd Undersecretary of the Army and Wharton School of Business lecturer, as well as Dan Kunz, who is the sales and tech executive, investor, and business leader, to break down the week's biggest topics affecting the nation's veterans. You can tune in to the premiere of Warrior Money this Friday, November 15th, 12:30 p.m. Eastern Time on the Yahoo Finance platform or wherever you get your podcasts. Coming up, your Yahoo Finance market update with our very own Rochelle Akufo. She'll check out how stocks are moving and run through 3 stories that you do not want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's market update. Stocks are mostly higher but mixed, continuing that post-election market rally heading into year end. As we can see there, the Nasdaq relatively flat at the moment. But here are 3 trending headlines that you need to know. First up, crypto exuberance continues with Coinbase, one of the biggest corporate donors during the election cycle, up now more than 17%. Pro-crypto campaign promises from President-elect Trump include firing SEC Commissioner Gary Gensler on day one of his presidency, but Gensler's term ends in 2026 and he can only be fired, quote, for cause. Next, aerospace and defense stocks have been outpacing the S&P 500 as the post-election rally continues. They're moving on a Trump presidency impacting existing conflicts, and as more AI companies, including Jeff Bezos-backed Anthropic and Palantir, announce deals with AWS, and Meta's Llama opens up for US intelligence and defense agencies. Plus, China's biggest shopping festival of the year, Singles Day or 11/11, is off to a lackluster start. E-commerce platforms from Alibaba, JD.com and Pinduoduo wrapped up the deals and discounts, but consumer confidence is still dampened on economic uncertainty ahead, despite stimulus measures from Beijing. Well, this has been your Yahoo Finance market update to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Brad Smith will return with Wealth, covering all of your personal finance needs after this short break.
A quarter of Americans under the age of 40 have at least some student loan debt. That's according to Pew Research. With President-elect Trump set to return to the White House in 2025, President Biden's student loan forgiveness plans will likely be impacted. Here to break down what this means for borrowers is Mark Krantrowitz, who is the student loan expert and author of the book, How to Appeal for More College Financial Aid. Mark, good to have you back on the program here with us. First, what are the biggest changes that you're anticipating once we go from a Biden administration to the incoming president-elect Donald Trump?
Well, President Trump has historically not supported loan forgiveness, so I would expect him to drop the Biden administration's efforts to implement broad student loan forgiveness and student loan forgiveness for economic hardship. All of those are being sued under the Administrative Procedures Act and other rules. I would expect them to file a motion with the court to drop their support for the programs.
So what does that mean for students and the more immediate kind of plans that they've already enrolled in?
Right. So those are new plans. And so current borrowers aren't affected by them. There is the Save Repayment Plan, which is also facing a lawsuit, and the court ruling is imminent on the legality of that plan. Currently, borrowers in the Save Repayment Plan are in an interest-free forbearance that will likely continue until the court rules. And then there will probably be an appeal of that ruling to the US Supreme Court. But it's unlikely to be any hearings or even a court ruling on such an appeal until after the Trump administration takes office. So if the Safe Repayment Plan is eliminated, as well as the repay plan upon which it was based, then the borrowers will still be able to choose the income-based repayment plan and the pay plan, which were both established by law, and Congress passed laws creating these plans, and the forgiveness that occurs after 20 or 25 years in these repayment plans.
Is there a pathway forward for students who are trying to see some type of forgiveness, even under the next administration? Is it clear what the former president, now President-elect Trump, campaigned on for the attention of students, if anything?
So Project 2025 and President Trump have opposed public service loan forgiveness. To get rid of it would require an act of Congress. Most likely, if Congress were to repeal it, which doesn't seem too likely, existing borrowers would be grandfathered in. So any changes to eliminate the public service loan forgiveness program would apply to only new borrowers who had not previously borrowed from the federal student loan programs.
And so
yeah.
Yeah, so all these things in mind, if you're a student that is trying to figure out where you can get and seek further financial aid, is there any change to the federal student aid that you can apply for that you should anticipate for the next school year?
Well, simplification of the FAFSA is ongoing. Hopefully, it'll be much better this year than last year. The Pell Grant has a new formula in addition to the old formula based on a comparison of income with a low multiple of the poverty line. So that's something that borrowers may be eligible for. There's also, if you have student loans, there's a student loan interest deduction that still exists. The Tax Cuts and Jobs Act of 2017 expires at the end of 2025. That will eliminate the tax-free status of certain loan forgiveness programs, not all of them. So after 20 or 25 years in an income-driven repayment plan, that seems unlikely to be extended, though you never know what horse trading may occur in Capitol Hill when members of Congress want one thing or another. The Republicans seem likely to have a majority, retain a majority in the House, and they already have a majority now in the Senate, but they don't have a supermajority, which is 60 votes required to prevent a filibuster. Now, they could eliminate the filibuster, or they could use a budget reconciliation bill, which is not subject to a filibuster, to pass legislation that cuts the budget by eliminating programs. But it remains to be seen what the White House and members of Congress will do in the next administration.
And just lastly, Mark, while we have you here, you actually mentioned within your notes interest rates, specifically on federal student loans, and what the anticipated changes are on that front. What are you looking for there?
Right. So the interest rates on federal student loans change each July 1st for new loans based on the last 10-year Treasury note auction in May. The current 10-year Treasury note auction yield is about the same as it was last May, which would suggest that there would be no change in the interest rates come May, but that's 6 months from now, and a lot can happen between now and then. Now, the Federal Reserve has been cutting interest rates 75 basis points, 0.75% so far, but that has not really had an impact on the 10-year Treasury note, in part because of concerns about the impact of tariffs and deficit spending on the inflation rate going forward. So a lot remains to be seen on what the Trump administration actually does and what impact that has on inflation, and therefore what the Federal Reserve does to cut interest rates.
Mark Kantrowitz, who's the student loan expert, joining us here today. Mark, thanks so much for taking the time. Appreciate it, as always.
Thank you.
Americans collectively owe $1.6 trillion in student loans, and the debt is a burden for many. 13% of federal student loan borrowers have not made payments on their debt during the, quote, on-ramp period, with 3/4 citing financial concerns as the primary reason for missing payments. That's according to a Pew Trust survey. According to our next guest, just a 1% decrease in college costs could have a major impact on the economy and Americans' personal finances. Joining me now, we've got Kamal Bhatia, who is the CEO of Principal Asset Management. Kamal, great to have you here with us. So a 1% lower cost for college. I mean, what does that look like quantified on a dollar basis, if we will?
Sure, Brad, good to be with you. So maybe I could take a step back and frame it for you. So we do this study across the globe, across 41 markets. And one of the things we wanted to focus on, it's called the Global Financial Inclusion Study we do, is to really think about the value of education and really frame the education policy impact on investments and investment outcomes. And what we did was the study, and we looked at that if a 7% increase in individuals attending higher ed across the world happened, it would lead to a 10% increase in GDP per capita over 5 years, which is quite amazing because the whole purpose here, I was listening to your prior guest, is about increasing affordability of higher ed and getting more people to participate in that. And then what we looked at was if you do it on a globally population-weighted basis, it would require an 8% reduction in cost for a 7% increase in enrollment. The most interesting thing, which I go back to your 1% number, is it would only take 1% in US to get to the same outcome, which is quite substantial because US is one of the most expensive places to go to higher ed. That is obviously because we have a very, very high quality higher ed system, but there is a very high cost of attending it when you include the total cost of attending higher ed in the United States.
So with that in mind, what are some of the biggest, perhaps, life movements that have to get pushed out as a result of the costs? And we talk about this time and time again, but I think for the amount of college debt that's being held and the amount of costs that people are incurring going into college as a family decision, it's not just having an impact on the person that is getting the education, but more largely, perhaps the family as well.
You're so right. So I think it's fascinating we use this term student debt, and the idea really should be student equity or human equity. And the two ideas are, how can we get college, and college is broadly defined, to be more affordable in terms of the total cost of doing that, so that not only do we have less debt burden, but we also have people think through going to higher ed as an equity creation. You know, it's fascinating. We talk about, as investors, a lot about monetary and fiscal policy and the impact it has on us as individuals and us as society, but also in terms of our investment outcomes. I do think a focus on education policy is very important around affordability and kind of reframing the value of education as equity rather than debt.
You know, as we think about students and how they're prioritizing the return on investment from any type of equity that they are getting in the relationship there from the college experience, how are you looking across where this and the future of work really ties into that too, because there is that consideration, making sure that you're going in for a study or a field where you're going to be able to not just pay down debt, but make sure that you're earning a living on the other side that you can benefit from as well.
That's absolutely a great point, Brad. So we are one of the largest managers of retirement plans around the world, and obviously a top retirement focused firm in the United States. And if you really think about this idea of the role of education that leads to student outcomes that eventually seeps in when you start work around savings and saving for retirement, our view is, I think, learning how to build equity early on, mostly through saving habits, is something not only do we teach at school, but kind of encourage the employers and the employees to actively participate on. Our view is if the debt burden is large, you essentially defer savings, you defer this ability to invest in your own retirement, and that perpetual cycle continues for a long period of time. So our view is encouraging better savings habits and thinking through what you invest in and the value it creates, just in terms of whether you're doing it for retirement or pre-entering a workforce, is very, very important. So looking at the risk reward of what you do with your career and your savings is very, very important.
Kamal, just lastly, while we have you here, our previous guest brought this up in what has been annexed to and tied back to President-elect Trump with Project 2025. And within there are some of the knocks on education and more largely an attempt to reframe or pivot the education system. Within that too, if we think about college, that could also mean that there's an impact to the types of colleges and universities, the types of funding that they get as well. How do you think that impacts the cost of college long term as well?
It's a great point. I think expanding the aperture of what we think of higher ed is absolutely the right thing, particularly with the advent of technology and AI, where it's going to take us. So I think you brought up this concept that higher ed is not just the very large colleges in America, but community colleges are an effective part of it, which certainly are affordable for many communities. But also the idea of training for technical skills is absolutely a valued focus. So I am personally a big supporter of thinking about the definition of higher ed to be more expansive. It's about skill training. It's about learning an ability to, as I said earlier, to manage how you manage your savings and learn about finance, but also getting more technical skills that are more valuable as a career choice.
Kamal Bhatia, who is the Principal Asset Management CEO. Thanks so much for taking the time, Kamal.
Absolutely, Brad. Good to be with you today.
Thank you. Health insurer Cigna says it's not pursuing a combination with rival Humana after reports the two companies were again discussing a deal. Yahoo Finance's Anjali Kamlani joins me now with the latest. I mean, this one even popped up into my X or Twitter, whatever we're calling it these days, my notifications. So what is the latest here?
Yeah, the latest is actually Cigna CEO David Cordani throwing cold water all over these speculations, which have resurfaced after a report earlier this year that put it back on the table. If you take a look at the timeline of this saga, we have seen that Cigna and Humana, it has been the will they, won't they, love affair of the healthcare industry for years. And they've had on and off intermittent conversations over time, Cigna bidding for Humana, and then Anthem bidding for Cigna at some point in time, but it has not happened. And this is good news for Medicare Advantage patients, because what is happening is essentially more competition, more options for patients. And that is something that would have been taken away if this deal came to fruition. Now, what that means also in the coming enrollment period, as well as for the coming years, is something that is going to be something to keep an eye on. Humana has enjoyed a large market share over time, but it has struggled to really compete financially. It offers a lot more benefits. It's widely popular with patients. And so what happens with the shift in how CMS grades these plans? It really got dinged this last round in comparison to some other companies. And so what the new enrollment period looks like, whether or not they maintain that market share, is going to be the thing to watch. And that's really the story to focus on for the Humana perspective on this.
Anjali Kamlani, thanks so much. much for continuing to keep tabs on this, breaking it down for us and the latest. We appreciate it. Everyone, we've got much more on wealth after the break. Stay tuned. You're watching Yahoo Finance. This week on Yahoo Finance's Financial Freestyle, host Ross Mack sits down with Jackie Robinson Burnett, who is the U.S. Small Business Administration Associate Administrator of Government Contracting. Here's a sneak peek.
And what a lot of people don't know is that the government spends $600 billion a year.
$600 billion.
That's a B. Billion. And Congress mandates that we spend 23% of that with small businesses all across the country. And I run that program that helps facilitate the contracts for that 23%. And last year, we awarded $178 billion to all types of small businesses.
New episodes of Financial Freestyle air Mondays, 12 p.m. Eastern Time. Since President-elect Donald Trump's win, Google searches for leaving the U.S. surged by over 1,500%. So if you're looking to live abroad, our very own Rochelle Akufo has more. Hey, Rochelle.
That's right, Brad. Post-election, the top searched Google term about leaving the US was moving to Canada. Makes sense. It's a shorter trip. English is its co-official language with French, and you don't need a visa. But for countries requiring a visa, VisaGuide.world found the top searches were moving to New Zealand. That had a 7,600% increase in traffic, followed by Germany, the Netherlands, and Ireland. Now, New Zealand is among more than 50 countries that offer a nomad visa, where you can live there and work remotely for up to a year. Now, if you want an even longer break from political discourse, you can take Villavi's 4-year cruise for $256,000 while visiting 140 countries, Brad.
I don't really do boats, so that's not an option. Are there any tax considerations that expats have to make?
Well, absolutely. Two things of note: the foreign tax exclusion and foreign tax credit. Now, Americans living abroad can already exclude up to $126,500 per person earned overseas from their taxable U.S. income. Now, most U.S. expats earn less than that. But the foreign tax credit lets you subtract foreign income taxes paid from your U.S. tax bill so that you don't get taxed twice. You basically pay the difference. Now, President-elect Trump said he supports eliminating double taxation. The tough thing is compliance can be burdensome, but they will still have to file those taxes, and that's going to affect an estimated 9 million American citizens who live overseas, according to the State Department, Brad.
All right. Rochelle, thanks so much for breaking this down, and a hotly searched item right now on the internet. Appreciate it. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination comes up 3 p.m. Eastern Time. You don't want to miss it.